You know, I don't know if it'll necessarily start with criminal prosecutions. Again, based upon what we've seen in other areas, it will most likely come back to what I believe is going to be the carrot and the stick. Similar to how we saw the OVDI programs and things like that, offshore disclosures. So for people not using too many acronyms, but some of the offshore disclosure programs, some of the compliance programs, even many of us remember over the past several years now, there's really been a push to sort of reclassify independent contractors to be employees, both on a federal and state level in many jurisdictions. Yep. And I think, again, that carrot and the stick model is probably going to apply. So can we get everything right? Can we know everything, especially where there's not guidance? Absolutely not. I do think that making the efforts, dotting the I's and crossing the T's for your clients, and ensuring that they take reasonably sound positions, because there are certainly some more aggressive positions which are interpretable as valid, but I would say probably are not going to boil out as the actual final, jurisdictional validation. I believe that doing that for your clients is going to keep them safer. I believe that reporting proactively is going to keep them safer. I believe that going ahead and taking a step back and saying, okay, do we have significant issues from prior years? Some of those are losses. We had some clients who were able to, go ahead and offset their gains with losses when they actually looked back. But certainly ignoring the issue when it's a question of unreporting, non-reported, etc., is very problematic. Another thing you're also going to encounter in this area is something where you're getting a lot of younger people who might not have ever filed a tax return, period, before. So sometimes we're going to want to file returns, and sounds sort of crazy, but we will sometimes file a zero return or a loss return to start the clock ticking on the statute of limitations. If you don't do that, you could have very easily a client who had 12, 13, 14, 15 million of crypto trading transactions and lost $5,000. Now, do you ignore it? It's 4 years old, let's say. You can't get the refund anymore. It's certainly not eligible for earned income tax credit. So what's the value of filing it? Well, at some point, there's some system out there that says they transacted 12 million in the USD equivalent. So the question is, do you report that? Do you start the clock ticking? And when do you do that? And I would say as early as possible, especially for the proverbial, college kids still living in their parents' basement or mining in their dorm room. A lot of this stuff exists, and they might not even know they even had an obligation, or might be below the technical legal filing thresholds based upon how the law interprets the amount of income they made, versus the way it's being reported, which is very important, is a gross volume. So certainly, to have one of these clients tick out on the matching program, if you want a substitute for return with a $4 million gain,
and we saw that with the 1099Bs for stocks and things like that. Or the person knows in their mind, well, I only made $5,000 or I even lost money, but the 1099, or in this case, the non-existent 1099, but the data source said you transacted 12 million.